Most people believe that superior investing is about information. Find the right data, build the right model, hire the right analyst, and the returns will follow. I have spent more than 50 years in this business, and I can tell you with complete confidence that this belief, however logical it sounds, is wrong. Not partially wrong, fundamentally wrong. The investors who consistently outperform are not the ones with the best databases. They are the ones with the most disciplined minds. Today, I want to examine something that rarely gets discussed in the way it deserves the mental architecture of a great investor. Not the tools, not the strategies, not the asset classes, the actual habits of thought that separate the people who compound wealth over decades from the people who chase returns and eventually destroy capital. There are 6 of them. They are not secrets. They are not proprietary. Anyone can understand them in an afternoon. But understanding them and actually operating by them are 2 entirely different things. And the distance between those 2 points is where most investment careers quietly die. Let us begin. Mental habit no 1. They think in probabilities, not predictions. Here's something I have noticed about the way most people engage with financial markets. They want to know what will happen. They want to forecast a number, a direction, up or down, recession or recovery, bull or bear. They want the future delivered to them with the same confidence that a weather app delivers tomorrow's temperature. And the financial industry, which profits enormously from the illusion of precision, is happy to oblige. The great investor understands something that this entire apparatus is designed to obscure. The future is not a single predetermined outcome. It is a distribution of possibilities. Some more likely, some less likely, but none guaranteed. Think of it this way. Imagine you are holding a coin. I ask you, will it land heads or tails? You cannot know. But if I tell you the coin is fair, you can say with complete confidence that the probability is 50% for each. That knowledge, not certainty about the outcome, but clarity about the distribution, is the foundation of every rational decision. Now, imagine the coin is weighted. Perhaps it lands heads 70% of the time. You still do not know the outcome of any single flip. But over 1,000 flips, the person who knows the coin is weighted will destroy the person who assumes it is fair. Not because they predicted correctly, because they thought about the problem correctly. This is what great investors do. They do not ask what will happen. They ask what is the full range of things that could happen and what is the probability of each. They build a mental distribution, assign rough likelihoods, and then ask a third question, a question that almost nobody asks. Given this distribution, is the current price compensating me adequately for taking on this range of outcomes? The failure to think probabilistically produces a specific and devastating error. It causes investors to confuse a good outcome with a good decision. If you drive through a red light and nothing happens, that does not make it a good decision. The probability of disaster was real. You simply drew a favorable outcome from an unfavorable distribution. Over time, the market is relentless in extracting payment from people who mistake luck for skill. I do not know what the economy will do next year. I will say that plainly. Neither does anyone else, regardless of how confident they sound. But I can think carefully about the range of possibilities, assess where current prices sit relative to a reasonable set of scenarios, and act with discipline within that framework. That is the first habit. And without it, nothing else works. Mental habit, no 2. They understand what risk actually is. The academic world has a definition of risk. It is called volatility, specifically, the standard deviation of returns. The idea is that an asset is risky if its price moves around a great deal. I understand why this definition exists. It is measurable, it is mathematically tractable, you can plug it into models and generate clean-looking outputs. It is also in important ways, wrong. Risk is not volatility. Risk is the probability of permanent loss of capital. These two things can point in the same direction, but they can also point in completely opposite directions, and when they diverge, the standard model fails catastrophically. Consider two assets. The first is a bond issued by a highly stable government. Its price barely moves. Volatility is low. By the academic definition, it is safe. The second is a basket of high-quality businesses selling at a 40% discount to intrinsic value. Because a panic has driven prices below reason, volatility is high. By the academic definition, it is risky. But which one is actually likely to destroy your capital permanently? The bond, if you are holding it during a period of unanticipated inflation that erodes its real value to nothing. The basket of businesses, almost certainly not, because time and value work together to correct the temporary mispricing. Great investors understand that there are actually three distinct things we call risk. First, there is the risk of losing money, the most obvious kind. Second, there is the risk of underperforming, falling short of benchmarks or peer groups. Third, and this is the one that almost nobody discusses honestly, there is the risk of missing out, the risk of watching others make money while you sit on the sidelines. That third risk is the most psychologically powerful of the three, and it is the one most likely to destroy a disciplined investor's framework. Because the fear of missing out does not feel like fear. It feels like opportunity. It feels like urgency. It feels like common sense. Everyone is making money in this market. Why am I sitting here earning nothing? And that question, asked enough times, is what drives otherwise rational people into overpriced assets at precisely the wrong moment. The perversity of risk, and this is something I have spent decades thinking about, is that it increases as prices rise, not as prices fall. When an asset is cheap, its risk is low. When an asset is expensive, its risk is high. This seems obvious once stated, but the market consistently behaves as if the opposite is true. Assets that have risen sharply feel safe because recent performance has been good. Assets that have fallen sharply feel dangerous because recent performance has been bad. The entire emotional logic of markets runs backward from reality. The second mental habit is this: know what you are actually measuring when you measure risk. Because if you are measuring the wrong thing with great precision, you are not managing risk. You are manufacturing complacency. Mental habit number 3. They practice second-level thinking. This is perhaps the most important concept I can offer you, so I want to develop it carefully. First-level thinking is simple. It asks, is this a good company? If yes, buy. If no, sell. First-level thinkers operate on the surface of reality. They see a strong earnings report and buy. They see a recession headline and sell. Their conclusions are correct in the way that a stopped clock is correct twice a day, occasionally. By coincidence, they align with the right action. Second-level thinking is different in kind, not just in degree. The second-level thinker asks, is this a good company, and does the consensus view already reflect that quality in the price? These are not the same question. In fact, the second question is the one that actually determines your investment outcome. Here is why. Markets are competitive. Millions of intelligent, motivated, well-resourced participants are analyzing the same companies, reading the same reports, attending the same conferences. Their collective judgment is embedded in the price. When a company is widely recognized as excellent, that excellence is already priced in. Buying it at that price is not a mistake, but it is not an edge. You are paying fair value for quality that everyone can see. The only way to generate superior returns, returns above what the market delivers, is to be right when the consensus is wrong, or to be right about something the consensus has not yet recognized. These are the only two sources of genuine investment alpha. This means the contrarian posture is not simply a personality preference. It is a logical necessity. If you always agree with the consensus, you will always perform in line with the consensus, by definition. But here is the nuance that most discussions of contrarianism miss completely. Being contrarian is not the same as being right. The consensus can be correct. In fact, it is correct a meaningful portion of the time. The second level thinker is not contrarian as a reflex. He is contrarian selectively when he has a specific, well-reasoned basis for believing the consensus has made a particular error. Intellectual courage without intellectual rigor is not contrarianism. It is noise. There is a sentence I have turned over in my mind for decades. It goes like this. To achieve superior results, you have to hold non-consensus views, and you have to be right. Both conditions are necessary. Neither alone is sufficient. And the second condition is the harder one because the market will make you feel wrong for a very long time before it makes you feel right. Mental habit number 4. They know where they stand in the cycle. I want to share an analogy that I find endlessly useful. Imagine you are a doctor. A patient walks in and you know nothing about their history, their age, their prior conditions. You can still take their temperature. A temperature of 104 degrees tells you something is wrong, even before you know exactly what it is. A temperature of 97 degrees suggests the body is not fighting an active infection. The temperature does not tell you the diagnosis, but it tells you the terrain. Markets have a temperature when asset prices are elevated relative to intrinsic values, when credit spreads are narrow, when leverage is abundant, when investor sentiment is uniformly bullish, when people are explaining why the old rules no longer apply, the market is running a fever. The infection has not necessarily manifested yet, but the conditions for serious damage are in place. When asset prices are depressed relative to intrinsic values, when good assets can be purchased at obvious discounts, when credit is tight, when sellers are desperate and buyers are absent, when people are explaining why this time the world genuinely might end, the market has a dangerously low temperature. Not because recovery is guaranteed or imminent, but because the distribution of outcomes has shifted dramatically in the investor's favor. Great investors are perpetual temperature takers. They are not trying to predict when the fever will break or when the hypothermia will reverse. They are simply trying to know at any given moment whether the current environment calls for more aggression or more defense, whether to lean into risk or lean away from it. Cycles are not perfect. They do not arrive on schedule. The pendulum can swing further in either direction than any reasonable person would expect. John Maynard Keynes captured this in a line that every investor should have tattooed on the inside of their eyelids. Markets can remain irrational longer than you can remain solvent. But the cycle always completes. It has done so in every market in recorded history, in every asset class, in every economic environment. The people who lose everything are almost never the ones who failed to predict the next move. They are the ones who believed the current environment was permanent, who extrapolated the present into the future without asking, what stage of the cycle am I in? What does history tell me about what tends to come next? The fourth habit is knowing where you stand, not where you are going, where you stand. It is the difference between a navigator who knows his current position and one who has been guessing his position for the last 3 days. Both face uncertainty about the destination. Only one knows how much fuel they have left. Mental habit number 5. They internalize the asymmetry of outcomes. Here is a mathematical fact that most investors intellectually accept but emotionally ignore. A 50% loss requires a 100% gain just to break even. If you invest $100 and it falls to $50, you need to double your money to return to your starting point. Not earn 50%. Double. This asymmetry has a profound implication that most investment frameworks fail to fully incorporate. It means that avoiding large losses is not merely important. It is the primary determinant of long-term compound returns. More important than finding the best opportunities. more important than correctly predicting market direction, more important than security selection skill. Charlie Munger, whose mind I have admired for longer than I care to admit, expressed something similar. I don't want to be smart. I just want to know where I'll die so I can make sure I never go there. The goal is not brilliance. The goal is the avoidance of ruin. I have watched investors of genuine intelligence destroy their track records, sometimes their entire careers, not because they made bad decisions across the board, but because they made one catastrophic decision without adequately accounting for the downside scenario. They built a castle with beautiful rooms on every floor and forgot to install a foundation. The asymmetry principle has a corollary that is equally important. In investing, the best opportunities are almost never found in the most popular assets. They are found in the overlooked, the misunderstood, the temporarily despised. Because the consensus has avoided these assets, their prices reflect not their quality, but their unpopularity. And unpopularity, when it is not accompanied by fundamental impairment, is precisely the condition that creates asymmetric return potential. When the downside is already priced in and the upside is not yet recognized, you are holding a bet where the range of outcomes tilts in your favor. That is the definition of an attractive risk-reward profile. Not a good asset, not a growing company, an asymmetric bet. The fifth habit is this: always think about outcomes in pairs. For every scenario you build about how an investment can succeed, build an equally rigorous scenario about how it can fail. And then ask, does the current price adequately compensate me for the failure scenario? If you cannot answer that question in detail, you are not ready to make the investment. Mental habit number 6. They treat humility as a competitive advantage. I want to close with the habit that ties all the others together and the one that investors are most likely to abandon at the worst possible moment. There is a particular kind of investor who does very well early in his career. He makes several good calls in a row. The market rewards him. His confidence grows. His positions get larger. His willingness to entertain contrary views gets smaller. He begins to believe that his judgment is not just good, but reliable, that he has developed a repeatable ability to see things others miss. He stops taking the market's temperature because he is certain he already knows the diagnosis. This investor, almost without exception, eventually experiences a loss of catastrophic proportions. Not because the market is cruel, but because the market has a way of distributing maximum pain to maximum confidence. The investors who last, who compound wealth over 30, 40, 50 years without a period of terminal damage, share a quality that is almost unfashionable to discuss in an industry that rewards bold predictions and aggressive posturing. They are genuinely humble about what they do not know. And they build this humility into their process, not just their personality. What does structural humility look like in practice? It means never sizing a position so large that being wrong about it threatens the portfolio. It means actively seeking out people who disagree with your thesis, not to defeat them, but to find the flaw in your own reasoning. It means maintaining a written record of your thinking so that you can examine honestly how your actual predictions compared to outcomes over time. The Greeks had a concept called epistemic humility, knowing the limits of what you can know. It is a virtue in philosophy. In investing, it is a survival skill. There is a division in the investment world between what I think of as the I know school and the I don't know school. The I know school believes that with sufficient data and intelligence, the future can be reliably predicted. They forecast with confidence, act with aggression, and judge their skill by the size of their wins. The I don't know school accepts that the future is irreducibly uncertain, that markets are complex adaptive systems that routinely defy even the most sophisticated analysis, and that the appropriate response to this uncertainty is not paralysis, but calibrated, diversified, defensively oriented action. I have been a member of the I don't know school my entire career. I do not consider this a limitation. I consider it a structural advantage. Because in a world where most participants are overconfident, the investor who correctly calibrates his uncertainty is operating with a more accurate map than everyone else in the room. Let me bring these 6 habits together now, because they are not independent. They form a system. You begin with probabilistic thinking, the habit of replacing single-point forecasts with distributions of outcomes. This gives you an accurate mental model of the decision landscape. You apply a correct definition of risk, one that focuses on the probability of permanent loss, not the oscillation of prices. This prevents you from confusing noise with danger and danger with noise. You practice second-level thinking, asking not just whether something is good, but whether it is better or worse than the consensus believes. This is where edge actually lives. You take the market's temperature, assessing where you stand in the cycle, so that you know whether the environment calls for aggression or defense. This prevents you from extrapolating the present indefinitely. You internalize the asymmetry of outcomes, building loss prevention into your process as the primary objective, and seeking investments where the failure scenario is already priced in. This is what makes compound growth possible over decades. And you treat humility as a competitive advantage, maintaining accurate calibration about what you know and what you do not know, so that your confidence expands to fill only the space actually supported by evidence. None of these habits is glamorous. None of them will generate a single headline. They will not make you famous for a bold prediction that turned out to be correct. What they will do over a long enough time horizon is something far more valuable. They will keep you in the game. The investors who do not survive long enough to be great are not usually unintelligent. They are usually overconfident. They take on more risk than they realize in pursuit of returns that the price does not justify based on a view of the future that the evidence does not support. The investors who do survive, who look back after 30 years at a record of consistent, defensible, compounding returns, almost always say the same things. They got lucky in some places and unlucky in others. They were right more than wrong, but wrong more than they expected. And they built their process in a way that made them survivable when they were wrong. That is the real edge, not the brilliant trade, the survivable mistake. Here is the challenge I am going to leave you with. Not something abstract, something concrete. Choose one of these 6 habits, the one you believe you currently practice least, consistently, and for the next 30 days. Make it the lens through which you evaluate every financial decision, large or small. If you tend toward false certainty, practice building distributions instead of forecasts. If you conflate volatility with risk, practice asking, what is the probability of permanent loss here? If you follow consensus by default, practice articulating specifically where and why you believe the consensus is wrong. If you ignore cycles, start taking the market's temperature every week and writing it down. The habits of mind do not change overnight, but they do change. And the investor who changes them, who slowly, deliberately replaces the instincts that markets exploit with the habits that markets reward, is not just a better investor, he is a different kind of thinker. The market does not know your name, it does not know your credentials, it does not care how much confidence you project in a conference room. It tests only one thing: whether you are thinking clearly when it becomes most difficult to think at all. 6 habits, 1 purpose, clarity under pressure, repeated across a lifetime. That's all. Thanks for watching.